My name is Jake, welcome to the channel. In today's video, I want to talk about the different investing approaches of feast or famine versus dividend growth investing. I had an interesting conversation a couple of weeks ago with a subscriber, and the subscriber was saying, yeah, he really liked dividend investing because it avoided the whole notion or the whole idea of, the feast or famine. And it really, I never really thought about dividend investing in that way. And as I thought about it these last couple of weeks, it really made a lot of sense. And it really got me excited because that's what it's all about. With dividend investing, you're not focused on the share price, you're really focused on the dividend or the dividend growth that comes from your investment. And so that's really where this idea came from for this video, is I was thinking, well, when you think about it, there's a couple of different approaches to investing, right? You got the whole buy low, sell high. I think most people can relate to that. I think most people, when you talk about real estate, you buy a house, you buy it at a low price in hopes that, somebody will come along and pay more for it than what you paid for. That's buy low and sell high. The other approach to investing is more of a cash flow, type of model where you buy an asset and that asset produces income for you. And after the revenue minus the expenses, that's your cash flow, that's your income and your earnings, and then you live off of that income. Now, both approaches to investing can work very well, and not everyone has the same mindset when it comes to building wealth and how they view their investments. So in this video, I want to talk about some of the differences between these two investing types or strategies and share with you some opinions why I much prefer the cash flow approach to investing or the dividend growth investing approach versus the feast or famine type that comes with investing in a buy low and sell high approach. As I was preparing for this video, there was a story that I learned as a kid that really kept coming back and back as I was preparing for this video. And I was thinking back on that story of the Pharaoh in the Old Testament talking about his dream or his vision of these 7 cows that were fat and plentiful, and that there were 7 cows that were skinny and scrawny, and that this represented 7 years of prosperity versus 7 years of famine or, drought, and meaning that there was going to be 7 good years and 7 bad years. You have an extreme on the one end where everything is going very well, right? Everybody is prospering, everybody's doing well. And then you have a time where things are not doing so well. And I was thinking about that when it comes to investing, especially in the S&P 500, when you look over the last, 90 plus years, you can see that there's been years when the market has gone up and there's been years when the market goes down. And no one can predict what direction the market is going to go. All we know is that the market works in cycles, right? It goes up and it goes down. And this whole idea of feast or famine brought a lot of stress and anxiety to me when I thought about investing, because I always thought that I had to pick the right investment at the right time, and I had to hold it for the right amount of time and sell it at the right time. And that brought on a lot of stress. And whether I'm thinking about the stock market being at all-time highs or being down 20 or 30%, or if I'm thinking about the housing market where my house is at all-time highs, or if my house price is depreciated 10 or 20 or 30%. And because the market goes up and down, you're having this roller coaster of emotions. And when things are going really, really well, when things are, asset prices, whether it's your house, the stock market, whatever, is at all-time highs, you're feeling pretty good compared to, for example, when you are in an economic downturn or in a recession, things feel completely different. And it can look a little like this. Oh my gosh. Oh man, I just had the biggest smile when I saw that. Oh man, I hope you all have a smile on your face as well. Now, before we go and look at some charts and I show you some different graphs, I want to share a personal story, and I think a lot of you will relate to what I'm going to share. So my parents watch the channel. So hi, Mom. The story that I want to share is a little bit about my dad here. So growing up as a kid, I would hear all the time that, we could go to Disneyland or we could buy a new car depending on what the market was doing. or depending on who was in the political office that year, right? And so I remember very, very distinctly growing up, and even now today, I still talk to, my dad about investing, and I hear this all the time. Well, it's an election year, so the market's going to turn around here in the coming year, or no, the market's going to go down because of this. And I remember very, often as a kid hearing that, and that feeling of that there's going to be a feast or there's going to be a famine. If this happens, we're going to eat. We're going to eat well tonight. If this happens, we're going to have to, eat chicken noodle soup and, our ramen, right? And so there was always this polar, up and down, this kind of roller coaster of emotions when it came to money, depending on different factors, right? Depending on the economy, the political landscape, or whatever. And so the reason why I'm sharing that with you, when you get in the mindset of, well, if this happens, once the election comes around, or once this happens, well, then we'll be able to afford that nice car or splurge on a little bit of this or that. And it wasn't until, many years later, once I got, into my late 20s, where I started learning more about, instead of the buy low and sell high approach to investing, but rather the cash flow investing approach, where you buy an asset and you're investing into it so that it can produce income for you, whether that be, through real estate, rents, or through dividend stocks that are generating dividend income for you. And once I realized that it didn't have to be the buy low and sell high, but you could also invest in assets that produce income for you, for example, dividend stocks, that really changed everything for me when it came to how I view investing, because you're not focused on the share price of something, you're focused on what that asset is producing, okay? And that's what we're going to take a look at here next. So for this part, I want to take a look at the feast versus famine approach to investing. And I'm not going to dive into like any fundamentals of any individual stock. I'm really going to keep it high level. I want to focus on the investing approach itself and not really anything else, right? So I want to keep it very high level and focus a little bit actually more on the emotional side, because investors, you and I, as human beings, we're very emotional. And I would argue that we tend to our actions, our behavior are more emotional based than factual or analytical based or critically, thought out. It's more focused on emotions. Okay. So as an example, I want to take a look at the historical performance of the S&P 500. Okay. So if I look at the S&P 500 over, the last, 20 plus years, what I want to focus on here is the volatility of when the market is up versus when the market is down, and what that kind of looks like in comparison when you're focused on more of a cash flow, type investment versus a buy low and sell high. So the S&P 500 or the total US stock market, the investing approach of the FIRE movement is generally following the 4% rule. And so you're buying and selling at specific times depending on your strategy. But there's going to be a lot more volatility and uncertainty when it comes to that, okay? And what I'm showing here is the annual returns at the end of the year, the end of the calendar year, what the portfolio or what the investment has done. Was it up or was it down that year? And what you can notice is that it's kind of all over the place, right? You can see in the early, mid 1990s, it was mostly up. And then the early 2000s, it was down. And then during the financial crisis, it was massively down. And you can see that the investments here are fluctuating. So once again, this is the S&P 500. Okay, now I want to take a look at Coca-Cola, for example. Coca-Cola is that sugar company. My favorite is vanilla Coke. I can't say no to vanilla Coke. I love it. But here, I want to show you a similar chart back from the mid 1980s, and you can see the amount of years that Coca-Cola was in the red versus being in the green. Now, Coca-Cola historically has been more of a defensive stock. So when the stock, when the market is going down, Coca-Cola is usually defensive. And so a lot of investors will flock to Coca-Cola as a risk-averse investment when there's times of market volatility. You can see here, you don't see those violent upswings to the up and to the down, And so that's really what I want to focus on. When you're investing in the feast versus famine type of approach, that's what you're going to get. So right, with the S&P 500, once again, you're going to get those violent swings Whereas with dividend investing, you don't really get those violent swings to the upside or to the downside. I want to give another example. These are just at random stocks that I pulled here, so there's nothing really particular with these two other than Coca-Cola has been historically very consistent, very stable, and I want to compare it to a company that has been more that boom or bust type approach, that feast versus famine. And so you can see with Bed Bath & Beyond, there's been years where Bed Bath & Beyond has absolutely destroyed or crushed Coca-Cola in terms of its total return. But the thing that I want to highlight, as a dividend growth investor, ideally, you don't want to see this volatility. You don't want to see these massive upswings and downswings. With Coca-Cola, the thing that I love about dividend growth investing is the consistency and the reliability of the investment or the asset that you're invested in. And this asset is producing income that is growing year over year. And that's what I'm comparing here, is this feast or famine versus this more slow and steady, consistent dividend growth investing approach. Now, before we jump into the next section of this video, I want to take a second and I want to say, I'm not suggesting that everyone go out and just buy companies like Coca-Cola. That's not what I'm saying at all. It really depends on your time horizon, your risk tolerance. All I'm saying by sharing this is this idea of, boom or bust or feast or famine really caused me as an investor a lot of stress, and it prevented me from investing for a long time. It wasn't until I really came across the idea of dividend growth investing, where I'm investing into an asset that is growing its dividend because the business is becoming more productive and more competitive, that it really helped me understand what kind of an investor I was. Okay, so I want to make sure that I say that, because if you're in your early 20s, it would be a mistake to just invest into really, really slow, growing, high dividend stocks, right? That would be a mistake in most cases. So it's important that you understand what I'm saying here. And I'm just talking about the different investing approaches, and you as an investor, you have to find the approach that works for you. And there could be some, a variation of this. Coca-Cola is maybe on the extreme of the conservative side, but maybe there's another company or another investment out there that kind of fits that good balance of consistency and growth. And we'll talk a little bit more about that, here throughout the video. So now when we look at dividend growth investing and we look at this investing approach versus, the boom or bust or the feast or famine, with dividend growth investing, it's really about finding an investment, an asset, a business that has a competitive advantage, that has, pricing power, that is sustainable, that is well managed, and that is growing and is becoming more profitable, so that they can return their shareholders, you and I, with a growing dividend. So if we look at the example of Coca-Cola, right? Coca-Cola, it's really just a sugar water company. Like, that's really, obviously there's much more to it than that, but really at its core, it's a boring business, but it's a business that serves a fundamental need in the marketplace, right? And you can see that through its results and through its growing dividend. The big thing here that I want you to understand is I'm not talking about dividend investing, right? Dividend investing is where you just talk about, a company that pays a dividend and that's the end of it. Dividend growth investing is fundamentally different, because the type of businesses that can grow their dividend year in and year out are very different than just companies that pay a random dividend. Okay, very, very, very important. And most people, when they think about dividend investing, they just think about these old utilities or telecom companies that are paying the same dividend for the last 10 years and it's been inconsistent. Dividend growth investing is different in that case, because the dividend is growing each year. Now, just because a company is growing its dividend doesn't mean that you're going to get rich overnight. Okay, when you think about dividend growth investing, generally this is a long-term investing strategy. This is a buy and hold, slow path to wealth type of investing strategy. And when I look at my experience here over these last couple of years of investing into dividend stocks, dividend growth stocks and ETFs, I can see, this snowball or this, this compounding take place in real time. Let me give you a few examples of a few different investments that I've been holding for the last couple of years here in M1 Finance. If I look at just as an example here at Target, I invested into Target back in the middle of 2019. I remember like it was yesterday, getting my first dividend from Target, 9 cents. And I was so excited back in June of 2019 when I got my first dividend from Target. I can't tell you how much, it was just one of the best days ever. It was such a small amount. And I knew over time that as I invested more money and as these companies that I was invested in, for example, Target, became more productive, that I was going to make more money every single year. And I love seeing that Target is continuing to grow. Now, this is a combination of the dividend growing itself, like we saw with Coca-Cola, as well as me investing more and more money into Target. Let's use another example here with Coca-Cola. If we look at Coca-Cola, it's a very similar story where I started out with a small amount, and as I slowly started growing and adding more and more, it's continued to grow. Now I'm going to show you an example of a few dividend growth ETFs that I have in the portfolio here. I look at DGRO, for example, I've had since 2019. My first dividend from DGRO was just under $1 at 99 cents. Now, every single quarter, I'm getting over $400 in dividends from my investment in DGRO. If I look at another example here, let's look at VYM. VYM, it's a dividend ETF from Vanguard. Very similar story where the dividend has continued to grow. And it is so motivating for me to see that these dividends, that they're growing and they're increasing. And then let's take a look at another one here. Let's look at SCHD. SCHD, very similar story where I was investing in this ETF back in 2019. Very, very small amount. I got 60 cents from the first dividend. It's mind-blowing to me to think that just a few years ago, I was getting 60 cents, and now I'm getting just under $900 in dividends each quarter. So it's something that it takes time, it takes effort, it takes money, it takes patience, but this is the difference between the feast or famine approach to investing and that which is dividend growth investing. For the remainder of the video, I want to share with you the most exciting part about dividend growth investing, the miracle of compounding. So what you're seeing here on your screen is a dividend reinvestment calculator that I created. I share this for free. I don't have a Patreon. There's no paywall. You can use this calculator for free. I will leave a link to this calculator in the pinned comment. Is one of the coolest things. If you're a dividend growth investor, you have to be using a calculator like this, whether it's mine or a different one. It is so encouraging and so motivating to see what your potential results could look like. Because at the end of the day, it's just math. It's finding the right investment vehicle. You hear me talk a lot about this, the vehicle that's going to help you get to your destination. Okay, so I've shared many different videos. I will leave a link in the top right where I introduce this calculator, and you can watch that other video if you want to look into this in more detail. You can read the notes down here that I share on how to use this. There's different tabs on the bottom that share the different types of stuff here. I have different versions of this calculator, a 50-year calculator. I have a dividend glossary. I track my own individual dividend income. So if you want to see my dividend income that I've been getting, I want to focus on this right here. So what we're looking at, this is a dividend reinvestment calculator. And what it's calculating is if you were to have an initial investment and if you were to have annual deposits, if you invested into different ETFs or dividend stocks, what would your potential portfolio value look like, as well as what would the dividend income look like? So what you're looking at here in the top is the historical performance of if you were to invest into DGRO and SCHD at a 50-50 portfolio allocation. Many of you have seen that video that I shared, the simple path to wealth. If you were to invest 50% into DGRO and 50% into SCHD, and you were to dollar cost average into them, these are the numbers that you would get based off of today. Now, historical returns are never a guarantee of future returns, right? Obviously. But as of today, I've already done the heavy lifting for you. These are the numbers if you were to follow what I'm suggesting, or, if you were to take a look at this. These are the numbers if you would do 50% SCHD and 50% DGRO. So now what I want to show you is if you're dollar cost averaging into SCHD and DGRO, what that potentially would look like. So now this part here in yellow, these two here, you're going to need to adjust for yourself depending on, your own personal situation. If you have $10,000 or however much you're investing. But I want to show you what we're just focusing on the dividend. The portfolio value, yes, that's great. But what we're focused on, we're not focused on the feast or famine, we're focused on the dividend income. So we're going to pull this over here, and this is just looking at the dividend income. So let's walk through this. If you were to invest into SCHD and DGRO at a 50-50 allocation, if you're dollar cost averaging into it over time, you could reasonably assume the following results, reasonably. Okay, so with a $10,000 initial investment and $1,000 per month that you're dollar cost averaging into this, these two ETFs, after 10 years, you would get roughly, or you could reasonably assume that you would be generating $8,000 a year in dividend income. After 15 years, you could reasonably assume that you would generate over $20,000. After 20 years, you'd be able to generate just under $50,000. And after 30 years, look at this. Look at this snowball. After 30 years, you could reasonably assume that you would generate over $250,000 in annual income. Isn't that incredible? If you're 20 years old right now, if you're, in your early 20s and you have a 30-year time horizon, isn't this incredible, right? That you could generate over $250,000 in dividend income from some of these, some of the best dividend growth ETFs out there. Now, just imagine that this was in a Roth IRA, for example. Now, with a Roth IRA, you're not going to be able to invest as much, right? But just you'd have to kind of look at your own personal situation. But now I want you to think outside of the box here. If you're able to invest $1,000 a month, this is what your reality could potentially look like over time. Now, let's say, for example, you were to side hustle, you were to get additional training, you were able to get a promotion, get a new job. And let's say that you were able to invest $2,000 a month. If you're able to invest not $1,000, but $2,000 a month because you saved on expenses, or were able to, make some more money on the side from your regular job, whatever it may be, it turbocharges your returns. And so remember how we talked about, it doubles the amount of dividend income that you could reasonably assume. This is the magic of compound interest, or the magic of compounding. Now, I want to do another one here. Let's imagine, for example, that you're a rock star and you're able to do $3,000 a month. I want you to hold on here. This might hurt a lot of your brains. I know this is definitely going to hurt my brain. Let's just imagine for a second that you were to invest $3,000 a month. So with $3,000 a month, after 10 years, you're generating around $23,000. After 20 years, you're generating around $135,000. And after 30 years, you're generating over $700,000. This is the magic of dividend growth investing. This is not feast or famine. This is not boom or bust. This is dividend growth investing. I'd encourage all of you to take a look at this. If you're new to investing, or if you're an experienced long-term investor, take a look at this, run the numbers, see how you can make the numbers work for you. See how you can find the right investment vehicle that will help you personally, you and your family, get to your destination. But here's the magical thing. The dividends, they don't stop growing after you and I leave this earth. They continue to grow and grow for many generations to come. Thank you so much for watching, and I'll catch everybody in next week's video.
Please subscribe. Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say Thanks. I'm glad you came along, partner.